All right, welcome back. Today we've got Reuben with We Lend LLC, and excited to learn more about what they're doing. I know they are a lender, and they're also raising capital. So, Reuben, appreciate you coming on the show.
John, thank you so much. It's a pleasure to be here. We lend money, and we also raise capital, and raising never ends, just like the lending never ends. So it's one of those that you're always kind of focused on, and you have to continue doing, because otherwise the business can't operate without the two.
Yep. Well, and it's lending right now. Well, I'd say in the past, 18 months, 2 years, lending has been all over the place. The 10-year treasury has been all over the place for the past, 2 or 3 weeks. Lending's just been kind of, I don't want to say unstable, but it's definitely changed. A lot of banks that I've been dealing with, 4 or 5 years ago, didn't ask for deposits in their bank. And now, actually, I had a buddy that he's, I think, 2 weeks out from closing, text me the other day and say, hey, this broker now all of a sudden wants to keep 100K of my refi proceeds. It's cash out refi. Now they want to keep 100K of it for a year. So
one
just
of the main reasons
things going on, I guess. Anything to expand on there?
Yeah, look, I think, the beauty about today's market is that it is the golden age of private credit. And what that essentially means is that because a lot of the banks are shrinking, and when I say banks, I mean community, banks that are local in nature, banks that you're driving by every single day, the homemade names, right? They are shrinking their lending performances and criterias. So that's where groups like us come in, and we actually help them bridge that gap, right? But as a result of many of the banks shrinking their lending, we have the ability to kind of dictate terms, which is a good in a way for an operator and investor in our fund, because then you're making good loans to good borrowers because you're able to dictate the terms. So I think today those lenders that are still continuing to lend have the ability and the flexibility to dictate terms that are not usually normal, and not what people are usually used to. And I think that's why your friend or your client is experiencing what he's experiencing. But I got to tell you, prior to starting our fund, we were real estate operators for many years ourselves, and it is the norm. If you're getting, some type of financing from a local bank, they want your deposits. It's always a requirement, and they'll say, look, we're cashing you out $1 million. We want you to have an average, deposit of $100,000 in your account. It doesn't mean that you can't use all the money that's in the account. On an average, on an annualized basis, they do like a little audit to see what the average was. So to your friend, if he's listening, I'm sure it's not going to be airing anytime soon, but when he is listening, they're looking at the average, and they really want the relationship, right? Banks today, lending is not an issue, right? We can lend, money left and right. It's to the right operators with the right relationships. And we lend are driven in the same kind of, ethos, you can say, right? We want to be able to work with, good operators that know what they're doing, have the experience, have executed, but also are committed to us. And I think for a bank like the bank that your friend is working with, their commitment is their deposits.
Yep, 100%. So let's start. I guess it sounds like you guys were in rentals. Kind of where did you start? What are you guys doing now? And kind of give us a brief background.
For sure. So a little introduction about myself. I know we kind of started off going straight diving into it, but obviously many of your viewers already know we are private lenders. We lend to real estate operators and investors nationwide. Our core focus and market is the Northeast. So New York is our backyard, right? That's where we're based out of, if you can't tell by my accent. New Jersey, Connecticut, and kind of like the Eastern corridor. So the Carolinas, Florida, and alike. We lend to real estate investors who are buying physically, financially distressed properties, repositioning them, and ultimately either reselling them or hold them in their portfolio. In fact, we did a little test run, and we've noticed and learned that in the past couple of months, or I would say about a good year or so, a lot of the operators that we have today are so bullish on the real estate market, appreciating whether it's tariffs or just inflation in general, that a lot of them are actually starting to convert their fix and flips into fix and holds. So a lot of them are actually converting into 30-year programs and holding on to their property, because the best way to be able to hedge inflation is by owning real estate. Not only owning gold, but also real estate.
Gotcha. So you said obviously you lend nationwide. What asset classes?
So we are very focused on residential asset classes. So we always want to have some kind of residential component to it. So we'll lend up to like 50 units and mixed use properties. And when we're lending on 50 units or mixed use properties, we always want to make sure on the mixed use property, at least, that the residential space is a lot larger than the commercial space. And the 50 units, obviously, it's always residential kind of space. We're not going to lend them to 50 unit office spaces or retail space or anything like that. Although we have done it in the past, and we like to do it as well, but it's only for borrowers that are actually returning to us, experienced operators. Again, going back to that same example that your friend is kind of going through today, we are really focused on working with borrowers that are committed to us. And as a result, we're going to be committed to them. So it's all really a relationship business.
Sure. No, that makes sense. So we do have a lot of our listeners are entrepreneurs, real estate investors, and I think a lot of them are probably also in self-storage. Will you guys lend on self-storage?
Will we? Maybe. Have we? No. The answer is no. And the reason why is, look, in the space of lending, there are lenders for lenders. There's banks for banks. There's groups that you're essentially kind of working with, whether it's through co-investments or other side vehicles or what have you. And a lot of the groups that we're working with today, they're more or less focused on the 1 to 4 units. They're more or less focused on the multifamilies with residential components to it or mixed use properties. We have seen a lot of the self-storage deals, but I think our focus today is really on the 1 to 4 unit multifamily and mixed use properties.
Okay.
Now, there are properties that we financed in the past that we would have said we would never finance, right? 30 unit, 40 unit conversion. We had a borrower buy a property in, I think it was the Carolinas, north or south. I always forget, always mix those two up. But he bought a stay-in kind of hotel motel and converted it to residential multifamily space. So we've provided financing for him there. It was about a $7 million loan. And it's something that, if you would have asked me 3 years ago if I would finance that type of deal, the answer would have been no. But hey, you never know, right? So to answer your question is that although we're not financing self-storage today, for all your viewers, give us a call. Let's talk about it. Let's see why this makes sense, who the operator is, what the asset is all about, and why this deal makes sense over others.
Makes sense. So let's go through kind of like an example of a deal. Someone's got, let's say I've got a 4 unit that I'm looking to purchase. It's going to obviously be value add. Kind of take us through what that might look like on your side and just numbers and everything.
Of course, happy to. So most of our guys are buying properties that are physically, financially distressed, right? These are properties that are off market. These are, maybe even estate sales, foreclosure sales. Our borrowers are coming in there negotiating a very good deal. Sometimes about 10 to 15% off of the as-is value. And we're giving them a percentage of that discounted value, right? Of their discounted purchase price, which puts us in a very comfortable and safe basis. Mm-hmm. But nevertheless, depending on the borrower's experience, depending on the asset, we can go up to 90% of the borrower's purchase price, 100% of their construction. Now, mind you, every single deal that we have, there's some kind of value add component to it. So construction is very, very important to our borrowers. They're not looking just for the acquisition. The acquisition is very important to them, but they need the financing for the construction as well. So we'll give them up to 100% of the construction financing, but that comes in stages, right? We're not financing the construction at the time that we're funding the deal at the purchase. We're only giving it to them as reimbursements for the work that they've done. And that's very important because that enables us to see exactly how the progress is moving along. The value is in fact being added. And again, putting me and my investors in a much safer basis to be able to continue making the loans and also being able to do so without any principal loss. And to your question earlier about a little bit about us, one of the things that I missed to say is the fact that we've originated over a little under $700 million across about 1,400 asset classes nationwide with zero principal loss. It's very important. Again, I say that zero principal loss. Can't really find that in real estate acquisitions, right? There are deals where you buy, you're thinking it's a home run, but guess what? Your construction has run up. Your value that you thought you're going to be reselling it has gone down. Your exit on the refinance, the lender that you're refinancing with doesn't see the same value that you saw going into the deal. So now you're maybe leaving a lot more money in the deal or losing money if you were to resell it. Whereas as a lender, you're in the safest part of the capital stack. And as a result, deploying $700 million across about 1,400 asset classes. That is the reason why we've never lost any principal.
That's awesome. That's awesome. So short term, it sounds like you do short term and long term funding. What do those terms and rates look like right now?
Yeah. So on the short term financing bridge type of capital, our rates are anywhere between, again, we're in April of 2025. And I say that for a reason because it always changes and fluctuates. But today we're right around, I would say, mid tens on the bridge capital, right? So the short term plus the construction.
And then term, you're talking under 12 months.
Exactly. So most of our loans are, not most, all of our loans are for a 12-month term, but most are actually repaid within 8 to 11 months. They need a few months for the construction, the rehab, the renovation, and then they need a few more months to be able to resell the property. So within 8 to 11 months, usually our loans are repaid, which is another real good benefit to investing into a debt fund because your exposure into the market is very short-lived versus having to buy properties. You're in a property for 3 to 5 years. A lot can happen in 3 to 5 years. I mean, we've seen in the past couple of days, couple of weeks, so much has happened. You can only imagine what can happen in 3 to 5 years. And I think for us, being a debt player with short-term terms, with monthly cash flow to our investors, and being in the safest part of the capital stack is really what attracts our investors today.
Gotcha. And you do, I looked at your website, you do long-term lending as well, right?
We do. We have a DSCR program, debt service coverage ratio program. Essentially, we want to be able to see that the property will at the very least service our debt, taxes, and insurance. And in that case, we'll lend up to, I think it's about 75% of the property's value. Obviously, no construction because the property is already rehabbed there. And the rates land, I would say, in the high 6s, low 7s there. And these are 30-year products.
And and we're going to get into it, but because I know you guys raise capital, but what are you following there with your rates?
I'm sorry.
What are you following with how are you getting your rates? Is that just,
It's based on SOFR. So it's 30-day SOFR, and plus, a delta on top of it. So it really, we're pegged against the SOFR, 30-day SOFR today. Got
it. What am I missing? I guess in that area, obviously pretty simple with all that stuff. But what am I missing?
Yeah. No, I think you hit it on the head. I think a lot of our borrowers today, going back to what I was saying earlier, is that the focus has been shifting really on holding properties versus having to resell properties. If you look back at our data, say 3 years ago, 4 years ago, most of our borrowers, I would say a good 70, 80%, were actually flipping their properties at the exit. Today, they're repositioning, they're holding them. But what we're also seeing is deals are not penciling out like they used to. John, I mean, I don't know what you're experiencing on your end. Our borrowers are having to be a lot more creative in getting deals to pencil out. So a lot of our borrowers are starting to do, conversions. They're starting to do vertical or horizontal extensions. They're buying the next door properties and reconverting that, right? There's a lot that they're doing to be able to attract the buyer, but also be able to get the most highest premium price for the asset. So, when we were buying, selling, flipping, developing real estate in New York, it was a little different. It was a lot easier, right? I mean, you were able to buy property, put some, TLC, some lipstick on it. You were able to resell and capture your, 50, 60% ROI. Today, our borrowers having to put a lot more work into it only to capture about a 25 to 30% ROI in the property. Just not the same business as it used to be. And that's why being a lender in a space and a time like today is really the golden era of being in this space. And that's why, if you watch CNBC, all you see is the golden age of private credit. And I'm so proud to be on this side versus the other side today.
Yep. No, I completely agree with you in that. I think that goes along with real estate too. If you can do deals now and you can make it through, the other side's going to be pretty good. With that said, are you seeing a lot of investors kind of being washed out, or are they taking a break, or what are you seeing?
So surprisingly, a lot of our borrowers, some of our borrowers are actually starting to invest alongside us, right? So they're investing into our fund because they just, one, they can't find the deals. Two, they probably got their ass handed to them on a few other deals, right? They're just not seeing the same type of deal flow as they did in the past. And I think a lot of our borrowers they understand our underwriting. They know exactly what we do, that we cross every T, we dot every I. So they're starting to transition their investment thesis from equity into debt. And I can't blame them, right? And the reason why is because, again, you're lending to real estate operators. You're in the safest part of the capital stack. You're the last one into the deal, but you're the first one out, meaning that before anyone takes out their equity, you as a lender are repaid first, right? I don't know if you own your own home, but if you were to have to resell your house today at the closing table before you take out your equity, the bank has to be repaid. And that's the beauty of it, right? Aside from that, it's liquid, meaning that you're not stuck into a deal for the next 3 to 5 years, hoping that things are going to go the way in which you plan for the next 3 to 5 years. You're in and out of deals within 12 months, sometimes even 8 to 11 months. Plus, it's cash flowing almost instantaneously. Within about 50 days of an investment, our borrowers are starting to receive direct deposits into their bank account, because as our borrowers are paying us their monthly interest, we're paying our investors. So I think that's what's been really attracting a lot of our borrowers and transitioning their investment thesis from being equity players into debt players.
Yeah. Yeah. And that's nice that you offer, you got two products there with that. So, excuse me, with your capital raising, what would that look like for me if I want to invest with you guys?
Very good question. So today our minimum investment is about 250,000. Average investment, I want to say it's right around 800,000. Some of our investors, we've made exceptions to, $100,000 investments as well. There are 3 classes of shares depending on the investment amount, but our investors today are earning anywhere between, again, we're in April of 2025, earning anywhere between about 12 to about 16% on an annualized basis with monthly cash flow.
Nice. And that's going into other people's deals, basically, correct?
Exactly. And we're vetting every single deal. We don't, outsource any of our underwriting or construction or anything to that effect. We have everything in-house. Our head of underwriting is Moses. He has a keen eye for all the trickery that's out there, right? He crosses every T, he dots every I. He is personally invested into the fund. I'm personally invested into the fund. Our other partner, Solomon, who's head of originations, is also personally invested into the fund. So while we like our borrowers to be aligned with us in their investments for the deals that we're financing for them, we are also aligned with our investors by being invested alongside them as well.
No, that's awesome, and that's a great point that you brought up, because if you guys weren't investing in the funds,
it would be alarming. Totally. Look, I mean, I've seen a lot of guys that made deals happen with equity investments where they've put zero out of pocket. In fact, I was talking to someone this weekend about it, that they've put nothing into the deal and they were able to get about 50% of the equity, which is great. I mean, it's amazing. I've just always had a hard time with that, right? Because it's hard to convince someone to invest into your deal when you're not invested. But his response, I mean, it's a valid response, is, Ruben, I have sweat equity, right? I'm putting in all the work. I have a team of 30 guys looking for these amazing deals. That in and of itself costs money as well. So I am essentially invested into the deal, just a bit indirectly. So kudos to him for getting that done, man.
Yep. Yeah. Well, and kind of somewhat related, we've seen in the commercial space, self-storage space, we've seen a lot of syndicators kind of get in trouble because they thought basically they're going in 100% finance, correct? Now it's value add. So they're hoping within 6 to 12 months that they can increase the value. But with cap rates all over the place past,
big red
months,
flag.
yeah, it's a problem. Now, obviously, if you're adding some of your capital in there, that helps a little bit. But yeah, it's an interesting time right now for syndicators.
You're saying the lender finance them 100%, or you're talking about between the lender along with their equity, they're at 100%?
Yeah, the combination. Yeah.
Oh, I see. Okay. Yeah. I was going to say, if the lender is financing them 100%, that is a big no in our space. I mean, we as fund managers want to make sure that every single one of our borrowers have skin in the game, right? Yeah. They're invested alongside us. And today, the average leverage that we're lending against the after repair value is right around 58%, which means that once the property has been repositioned, there's about 42% of equity built into the deal. So in the event of a default, we have about 42% of equity that's already naturally built into the deal, which puts us in a very, very comfortable position. But also, the average leverage today is right around, I want to say 80%, right? So to the borrower at the acquisition. which means that the borrower has about 20% of equity built into the deal the day that we finance the deal. Again, 20% of equity that they've put up alongside with starting the construction and closing costs. So if you combine the construction, you combine the closing costs, they're about 30% of skin in the game into the deal the day that we finance it for them. And I think that alignment of interest is critical to us.
Yep. No, that's great. What separates you guys from, I guess, other companies or any other type of lending similar to you guys?
I love it. That was a layup for me. I appreciate that. And it wasn't planned. But I think for us, one of the key important parts is no one in my office has a desktop phone. We don't believe in it, right? Every single person in my office has a cell phone. That is critical for us. And the reason why is because there are times where borrowers need to close quick. And when I say quick, I mean 24, 36 hours. We pride in the ability to be able to do that, deliver them the financing, the funds in 24 to 36 hours. Now, on an average, we close within 5 to 7 business days, but we have the ability to close within 24 to 36 hours. And I say that with emphasis because that is very, very hard to come by. To be able to find a lender that can give you really effective cost of capital within 36 hours is really, really a unicorn in this space.
I like that. That's awesome. That's great. This just kind of hit me, but I've got some friends, quite a few friends, and it seems like it's a natural trajectory for real estate investors. What would your advice be for anybody that wanted to become a hard money lender?
Oh, man.
They want to do it on a small scale.
Look, we had to learn before we started our fund, right? For a good several years, we've made loans with another larger group that's been doing it for many years before us, right? Mm-hmm. And we were investing. First, we started brokering the deals over to them. Then we started investing alongside them. And then we kind of softly launched our fund and we started making our own loans while still co-investing with them. Yep. And the reason why we did that is because, look, I'm a very big believer in walking before I run, crawling before I walk, walking before I run. And, the reason why we did that is because today, most of the capital that we are deploying is friends and family, right? We want to make sure that every penny we deploy, we get back plus interest, right? And the only way to be able to do that is learn the process. We were fixing and flippers, right? We were buying, selling, flipping, developing real estate and wholesaling real estate in the New York area for many, many years. We knew what it was like to be a fix and flipper, but we knew nothing about the lending space. So what I would recommend is first start brokering deals, right? Get some deals into your pipeline, start brokering them out, start seeing how the underwriters look at these deals. Because something that may look like black and white is not, right? When things just look perfect, something is up. And you have to have a keen insight into finding that little hair, right? And it could be something very small that can convert to something very, very big. I'll give you an example, right? We had a property where there was about 2 or 3 wholesalers in the deal. Nothing suspicious about that. It happens, right? But what we've learned later on is that the last 2 wholesalers were actually connected to the borrower, right? The borrower that was actually coming to us for financing. And the reason why I say that is because when you see some type of connection of that sort, and again, it's not something you were able to find. We have, software to be able to find connections, and we do background searches on the borrowers. We also do background searches on the wholesalers and so on. We found that they have matching addresses. Question is why? Why would the wholesaler and the borrower have the same office space, right? There's something suspicious about it. Mm-hmm. Well, we were right on, right? Moses hit it on the head. Turns out the borrower was trying to wholesale himself the deal and not have to come up with any type of money to the table at the closing. For us, alignment of interest, just like we are aligned with our investors, alignment of interest with our borrowers is critical. We had to turn down that deal. And the reason why we had to turn down that deal is because the borrower has to have skin in the game alongside us.
That's awesome. That's some great advice. Couple last questions here. You're hitting on everything I wanted to know. Where do you see you guys going in the next 5 to 10 years?
That's a good question. I never looked that far. I wish I did, right? I wish I had the brain to be able to do that. I don't think that far. I think more like a year and a half away, right? And I think, because my mind is focused on what I have to do in a year and a half, I think from that context and that viewpoint, the key here is to bring in more institutional capital to our field, right? It's great to be dealing with friends and family, but the problem is the cost of capital from friends and family is very expensive. Mm-hmm. So what we've been focused on, and we will be focused on for a good year or so, is to bring in more of institutional capital, because that cost of capital is a lot more effective. And as a result, that effective capital for us means effective capital to our borrowers, who are also our dear friends, our clients. And I think for us right now, the focus in, say, the next under 2 years is to bring in more institutional capital to be able to give effective cost of capital to our borrowers, who are also our dear friends.
Love it. Love it. What do we miss?
What do we miss? I think we hit everything on the head. I made sure to kind of rear off any question that you had, and forgive me for adding more than what you asked. So I tend to do that all the time. Don't ask my wife, but she probably would agree. So I think we hit everything on the head, John. I really appreciate it.
Love it. Well, appreciate your time. Where obviously we'd love for, and I'm disclaimer, I've not used you guys, but
not yet.
If people would like to reach out and learn more, where can they find you?
They could visit us on our website, www.welendllc.com. We're also on all major social media platforms, including TikTok for now. God knows what's going to happen with it. And our handle there is We Lend LLC.
Awesome. Well, yeah, guys, feel free to reach out, gather more information, get with Ruben. And again, appreciate you coming on.
Thanks, John.
We'll see you guys.
Thanks for following, subscribing, and listening to this episode of the Do More podcast, hosted by John Farling. To learn more or ask questions, go to l4investing.com.